Welcome to PwC IFRS Talks, your source for all things IFRS. I'm your new host, Raihazah Shaikh. I'm very excited to be hosting PwC's IFRS Talks podcast. For those that don't know me, I'm a senior manager in the Global Accounting Services technical team at PwC, and I'm passionate about all things IFRS. IFRS Talks aims to provide an update on the latest accounting developments, what to look out for, and how this might impact you. Andrea's done a fantastic job over the past couple of years, and I wish her all the best in her new role. So let's begin. Today's IFRS Talks is a continuation from podcast 127, and I'd like to welcome back Karsten Ganssauge. Thanks for joining me today.
Hey, Raihazah. Thanks for the warm welcome and looking forward to working with you more closely going forward.
Thank you. So the March IFRS Interpretations Committee, there were two agenda items that focused on the accounting implications of special purpose acquisition companies, also referred to as SPACs. Both of these agenda items had a similar underlying theme, which is the age-old question of whether an instrument was debt or equity. The first of these agenda items questioned what the effect of shareholder discretion was on the entity's ability to avoid payments in cash or another financial asset, and therefore how that might impact the classification as a liability or equity. And the second agenda item was a scoping question to understand whether IFRS 2 or IS 32 is the applicable standard, and if it is IS 32, is the classification liability or equity. Karsten, shall we begin by reminding our listeners what a SPAC is and how they are structured?
Sure. So a special purpose acquisition company, or SPAC, is an entity that is created with capital from its initial investors and then undergoes an IPO to raise additional capital with the intention of acquiring one or more unspecified operating companies, or OpCos. The IPO proceeds are placed into a trust, and the SPAC typically has around 18 to 24 months to identify and complete the acquisition of a target company, which is often referred to as the SPAC merger. Once the SPAC IPO has happened, and before the SPAC merger, a SPAC is essentially an entity that is listed on a stock exchange and which does not have any operating business. It basically just has cash and a financing. So if the target search is successful at the time of the SPAC merger, the OpCo becomes a public company or the legal subsidiary of a public company via the merger with the SPAC. However, if the SPAC does not complete the SPAC merger within a specified time frame, and in the absence of any extension, the SPAC will typically liquidate and return the remaining IPO proceeds to its shareholders. So what's the purpose of these structures? Well, from the perspective of the OpCo, the purpose of the SPAC is essentially to be a vehicle, to achieve a listing on a stock exchange without going through the formal and often time-consuming process of an IPO. In order to achieve this, the SPAC may legally acquire the OpCo so that the OpCo becomes the legal subsidiary of the SPAC, or the OpCo may acquire the SPAC. Now, the structure of these transactions vary quite a bit. For example, it's quite common to create a new entity or new co that would be involved in the transaction in addition to the previously existing SPAC and OpCo. Now, there are various reasons for involving a new co. Most commonly, a new co would be involved for tax reasons, or in the case of a SPAC listed in the US, the purpose of the new co may also be to achieve foreign private issuer or FBI status, and thus allow an entity to prepare financials based on IFRS rather than having to prepare US GAAP financials. The balance sheet of these SPACs are typically very simple, as they would typically just contain cash and the financing. However, these transactions would often still involve highly complex accounting questions. These complexities typically arise both before and at the time of the SPAC merger. Now, the first issue that needs to be analyzed is typically whether the entity or the SPAC is the acquirer for accounting purposes. There will typically also be complex questions in a number of other areas, including issues around share-based payment, both in relation to the employee services provided by the SPAC founders and in relation to a listing service provided when the SPAC merger is executed. as well as questions around the accounting for any shares and warrants issued in these transactions, and whether these instruments would be classified as debt or equity. So I was not planning to go into all of these complexities, but I will touch upon a few of these in a minute when we talk about the issues that have been submitted to the IFRIC in that regard. So overall, I think we definitely have some really interesting and quite complex topics on the agenda for our listeners today. So it will be a challenge. It's not going to be easy, but I promise I will do my best and try to convey these as simple and clearly as possible.
Thanks, Karsten. Indeed, definitely quite a complex fact pattern and quite a complex structure that we're dealing with, which do bring about many accounting challenges. Let's move on to the first issue. Could you perhaps just provide a little bit more background to our listeners on what the fact pattern was?
Yes, sure. So on this first issue, the issue essentially relates to the accounting for the financing provided to the SPAC in the SPAC's financial statements after the SPAC IPO, but before a SPAC merger occurs. So in the submitted fact pattern, a SPAC has issued two classes of shares, founder shares and public shares. Now, to better understand the background of the issue, let's have a look at what might happen in the SPAC after a SPAC listing. Either the SPAC identifies and acquires a target within a specified time frame, in which case there will typically be some form of put option for the holders of the public shares, or the SPAC does not execute the transaction, in which case the SPAC is either liquidated or the shareholders may decide to extend the life of the SPAC with the objective of continuing to search for a suitable target. Now, the terms of these arrangements vary. For example, the decision as to whether to acquire an identified target company may be approved either by the shareholders or the management of the SPAC, depending on the terms and conditions of the SPAC statutes. However, once a target is identified and approved, the public shareholders individually have the right to require the reimbursement of their shares. In some SPACs, however, only shareholders voting against the acquisitions have this right. So if no company is acquired within a specified period of time, the SPAC is liquidated unless the statutes of the SPAC allow for an extension of the SPAC's life and the shareholders vote in favor of such an extension. Upon liquidation, the net proceeds of the SPAC's IPO would then be distributed to the SPAC's shareholders. However, quite importantly, typically there will also be a possibility to extend the life of the SPAC, which I understand would generally already be part of the contractual terms when the instruments are issued. Also, the procedure how the SPAC's lives can be extended varies in practice. So in the submitted fact pattern, the decision to extend the SPAC's life is either approved by 2/3 of the shareholders in a shareholders meeting or by 2/3 of the founder shareholders and 2/3 of the public shareholders independently in two separate shareholder meetings. So the exact structure of these arrangements can vary quite a bit.
Thanks, Karsten. That was a really helpful summary of the fact pattern. Could you now maybe provide a little bit background on the accounting issue that arises as a result of these decisions?
Sure. So quite simply, the question raised in the submission was whether the public shares should be classified as equity or as a financial liability. In order to assess that question, essentially the question is whether the SPAC entity has a contractual obligation to deliver cash or another financial asset. So this may sound like a simple question, but in fact it's not. The complexity here is to assess whether decisions that are made by the shareholders, say in a shareholders meeting, are considered to be decisions of the entity.
Definitely not an easy issue. So, what were the committee's views on this issue?
Yeah, so given the shareholders have the right to extend the life of the SPAC, the complexity is whether the life of the SPAC can be extended indefinitely and whether a shareholder decision made in a shareholders meeting should be considered to be a decision of the entity. So again, in simple terms, the key question really is whether, and if so, under which circumstances, a decision that is made in a shareholders meeting would be considered a decision of the entity itself. Again, IS32 is clear that there's a liability if the entity does not have an unconditional right to avoid delivering cash or another financial asset. However, this standard essentially has no guidance to determine whether a decision of shareholders is treated as a decision of the entity. So the committee observed that IS 32 contains no requirements in that regard, and also acknowledged that similar questions about shareholder decisions arise in other circumstances. Also, this matter has been identified as one of the practice issues that the ISB will address in its financial instruments with characteristics of equity or FICE project. Therefore, the committee concluded that the matter described in the request is in isolation too narrow for the ISB or the committee to address in an efficient manner. And so the ISB should consider the matter as part of its broader discussions on the FICE project. For these reasons, the committee tentatively decided not to add a standard setting project to the work plan. However, the committee nonetheless noted the importance of the SPAC disclosing information in the notes about the classification of its public shares.
Thanks, Karsten. I think that's really helpful and definitely an important one, even though there may not be a finalized agenda decision explaining how to account for this currently. There is still the expectation that disclosure should be provided based on existing requirements. So let's move on to the second question, which seems to have maybe a slightly unexpected analysis in our view. Could you start by providing our listeners again around the background on the fact pattern of this issue?
Sure. So this submission is another submission on the accounting related to a SPAC. However, this submission is essentially about the accounting for a particular type of SPAC at the time of the SPAC merger. More specifically, the request asked how the entity accounts for warrants that are issued in a particular SPAC structure at the time of the SPAC merger. So this is quite a complex fact pattern that results in complex accounting issue. So this isn't going to be easy, but I try my best to keep this as simple as I can. So let me start by describing the fact pattern in a bit more detail. In the fact pattern, the committee discussed an entity acquires a SPAC that has raised cash in an IPO. So the purpose of the acquisition is for the entity to obtain the cash and the SPAC's listing. Now, quite importantly for the accounting analysis, a SPAC typically just holds cash and the financing, and therefore the SPAC does not meet the definition of a business in IFRS 3. So before the acquisition, the SPAC's ordinary shares, which are classified as equity, are held by its founder shareholders and public investors. Now, in addition to ordinary shares, the SPAC had also issued warrants to both its founder shareholders and public investors. So in addition to the founder shares and the public shares, the SPAC has also founder warrants and public warrants. Now, the founder warrants were issued at the SPAC's formation as consideration for services provided by the founders before the SPAC merger. And the public warrants were issued to the public investors with ordinary shares at the time of the IPO. So in the SPAC merger, the entity, via a newco, acquires the SPAC by issuing new ordinary shares and warrants to the SPAC's founder shareholders and public investors in exchange for the SPAC's ordinary shares and warrants. So essentially, the SPAC shareholders give up their existing shares and warrants in the SPAC in exchange for new ordinary shares and warrants of the entity, in this case via a newco. Also, the entity's owners control the group after the transaction, and the SPAC becomes a wholly owned subsidiary of the entity. So the entity effectively replaces the SPAC as the entity listed in the stock exchange. And finally, the fair value of the instruments issued to acquire the SPAC exceed the fair value of the identifiable net assets of the SPAC. Now, this is because the entity would be willing to pay a premium to compensate for the fact that the SPAC is a listed entity. So essentially, the entity is also paying for a listing service in order to get listed on a stock exchange. So in the case of this submission, another complexity is that the OpCo entity is issuing new shares and warrants via a newco that sits on top of the OpCo as a holding company before the SPAC merger. So these transactions are quite complex. And so I realized that even the simplified fact pattern that has been submitted is still quite complex. So in very simplified terms, I think this can be summarized as follows. An entity acquires a SPAC, which does not meet the definition of a business and essentially has nothing but cash and a related financing, as well as a listing on a stock exchange. In exchange for the acquisition, the the shareholders of the SPAC that have been holding both shares and warrants in the SPAC receive new shares and warrants that are issued by the entity.
Thanks, Carson. I think that was really helpful just to walk us through, the pre-merger and post-merger accounting, how it all sort of comes together. So following that background, put simply, what was the crux of the accounting issue that the committee were discussing?
So submitter asks two questions in relation to the warrants that are issued as part of the SPAC merger by the new co to the SPAC shareholders. The first question is whether these warrants are in the scope of IFRS 2, so the share-based payment standard, or whether they represent a liability assumed by the entity as part of the acquisition. And the second question is, if the warrants are in the scope of IFRS 2, whether they remain so after the acquisition date. Now, for background, let me remind folks that IFRS 2 and IAS 32 contain different classification requirements for financial instruments within their scope. So, for example, a warrant that fails the fixed for fixed criterion for classification as an equity instrument could still be considered an equity instrument for purposes of IFRS 2, and thus could be part of an equity settled share-based payment transaction. That's really why this question about the scope arises, or primarily why this question about the scope arises.
Thanks, Karsten. Definitely, the interesting discussions are always around those that are crossing different scoping standards. So what did the committee think about this?
Yeah, so again, this is quite a complex fact pattern with quite complicated accounting issues involved. So I wasn't planning to go into all these complexities, but let me try to summarize some of the key points from the discussion. So the first question that needs to be analyzed is who is the acquirer in the transaction and whether there's a business combination. Now, those listeners who are familiar with business combinations accounting will be aware that the entity that is legally acquiring another entity is not necessarily the acquirer from an accounting perspective. So in the submitted fact pattern, the entity, rather than the SPAC, is the acquirer for accounting purposes. Also, because the acquiree, that is the SPAC, essentially just contains cash into financing, it does not meet the definition of a business. Therefore, the SPAC merger does not meet the definition of a business combination in IFRS 3, and the transaction would instead essentially be accounted for as an acquisition of cash and a listing service. Second, it needs to be considered how to account for the financing in the SPAC, and in particular, whether the warrants in the SPAC are assumed as part of the acquisition, that is, whether the SPAC warrants are part of the net assets acquired. Now, this is not an easy question considering that the SPAC warrants are replaced by new warrants issued by the acquirer as part of the SPAC merger. So essentially the question here is whether the warrants should be considered to be extinguished when doing the acquisition accounting, and so whether the new shares and warrants are only issued for the acquisition of cash and a service, or whether instead the SPAC warrants are part of the net assets acquired and then replaced with the new warrants immediately thereafter. Now, on this question, the committee tentatively decided to issue some rather generic consideration on what to consider in making this assessment, which would include consideration of the legal structure of the transaction, as well as the terms and conditions of the warrants in the SPAC and in the entity before and after the transaction. So on this point, depending on the specific terms and conditions of the transaction, the entity might conclude that the terms and conditions are such that it either assumes the SPAC warrants as part of the acquisition, or that it does not assume the SPAC warrants as part of the acquisition. Now, that determination of whether the warrants are assumed as part of the transaction is a key question in the analysis that really drives the accounting. This is because if the warrants are assumed as part of the acquisition, this means that there's a financial liability assumed as part of the net assets acquired. So essentially, this means that the accounting guidance for financial instruments in IAS 32 applies in terms of classifying those acquired warrants. On the other hand, if the warrants are not assumed as part of the acquisition, this means that the new shares and warrants issued by the entity are issued as consideration for the acquisition of cash in the listing service only, in which case it needs to be determined which IFRS standards applies to the acquisition of the cash and the listing service. Now, whilst the stock exchange listing does not meet the definition of an intangible asset, IFRS 2 applies in accounting for all share-based payment transactions, whether or not the entity can identify specifically the goods or services received. So in the submitted fact pattern, the fair value of the instrument issued by the entity to acquire the SPAC exceeds the fair value of the identifiable net assets acquired. Therefore, the entity is also receiving a stock exchange listing service for which it has issued equity instrument as part of a share-based payment transaction, and which is measured as the difference between the fair value of the instrument issued to acquire the SPAC and the fair value of the identifiable net assets acquired. So for this stock exchange listing service, the share-based payment guidance in IFRS 2 applies. So in summary, depending on the specific facts and circumstances of the transaction, the entity issues ordinary shares or ordinary shares and warrants in exchange for acquiring cash, for the stock exchange listing service, and for assuming any liabilities related to the SPAC warrants, if any. Therefore, the committee concluded that the entity applies IFRS 2 in accounting for the instruments issued to acquire the stock exchange listing service, and IAS 32 in accounting for instruments issued to acquire cash and assume any liabilities related to the SPAC warrants. So this is essentially a high-level summary of the committee's tentative conclusions. I realize this is quite complicated, so if you're interested in more details on this topic, I recommend you have a detailed read of the tentative agenda decision as well as the related staff paper.
Thanks, Karsten. And what are your personal reflections on this issue?
First of all, I think a key takeaway on this matter is that entities need to think about whether or not they have acquired the SPAC warrants. I think this is no surprise, as this has been one of the key considerations in practice in the past. Now, as I mentioned, the TAD is providing a bit more guidance in this area, but my sense is that there may still be some judgment involved in making that assessment, depending on the legal structure and the exact facts and circumstances of the transactions. Second, if an entity determines that it does not assume the warrants as part of the transaction, the TAD suggests that in addition to the application of IFRS 2 for the acquired listing service, an entity would apply IAS 32 to account for the shares and warrants issued to acquire cash. This means that an entity would need to think about which instruments were issued for cash and which were issued for services. Essentially, this means that the entity would need to allocate the shares and warrants issued to the acquisition of cash and to the acquisition of the listing service. However, there are no requirements in IFRS standards that specifically apply in doing that allocation. Now, the staff paper is suggesting that this might be done on a relative fair value basis, which seems a reasonable method, but also quite complex, and also, at least in my mind, raises some questions about the subsequent accounting for the warrants issued. Personally, I think that this conclusion actually does come as a bit of a surprise, as I'm not aware that such an allocation has actually been done in practice in the past. So this is definitely something to think about. And my sense is that this may substantially change practice going forward if this is finalized.
Thanks, Karsten. That's a very valuable personal insight into the matter. And I agree, if this is an issue impacting you as our listener, or you would like to learn more about the issue, please take a read of the staff paper and the tentative agenda decision. Both the issues discussed today are subject to a tentative agenda decision, which are now open for comments. The deadline for those comment letters is the 23rd of May. Karsten, thank you for sharing your insights into the IFRS Interpretations Committee. As always, it's very helpful and a great summary of the meeting and what the key points raised were. I'd like to end by saying thank you to all those listening. I hope you found it as insightful as I did. And until next time, stay safe and happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.